How are capital gains taxes different for a short-term and a long-term investment?
Yeah, in short term. So short term and long term is under or over a year. So if you hold the thing for under a year, it's short term. If it's over a year, it's long term. So short term is just taxed just like any other income. If you got a dividend or interest or whatever, it's just your ordinary income rate. So if you're in the 22% bracket and you have a short term capital gain, you're going to pay 22% on it. On long term gains, there's a lower bracket. And this is also true of qualified dividends. So long term gains, it's going to depend on your total income for the year and what bracket that places you in. And then rough numbers. If your total income for the year is 0 to 50K, your long-term capital gains are zero, and then above that it goes to 15%, and then above that it goes to 20%. And then there's also another potential tax that you might be paying called the net investment income tax of 3.8%, and that's an Obamacare tax that gets assessed on investment income if your income's high enough. So 0, 15, 20, 23.8 is the spread for long-term capital gains. Whatever the capital gains rate you're paying is for long-term, it's always going to be less than your ordinary rate, and roughly 2 to 1. So if you're in the 24% bracket for regular income, your capital gains rate's probably the 15% bracket. So that's something to keep in mind. I will tell you, long-term capital gains rate discount is not all it appears to be. And the reason is that this is one of the only places in the tax code where you are paying current dollars on old dollars. You have to take into account the inflation that you've paid for, quote unquote, paid for over the years that you've owned that asset. So if you put $100,000 into something in 2000 and you sold it for 150,000 in 2025, then okay, so that's a 50,000 nominal gain, and you're going to pay tax on the $50,000. But in real terms, in inflation adjusted terms, you probably have a loss that you're still paying taxes on. It's brutal. The long-term capital gains, in again, depending on the situation, depending on the numbers, depending on the years involved, can be an infinite tax rate because you're actually paying tax on money that you lost in real terms, even though you gained in nominal terms. So it's slippery. And this is a point I've made more and more over the last year or so that people are really unaware of because we only deal in nominal terms, right? Oh, I bought it for 100, I'm selling it for 150, great. Well, what's that 100 worth from 20 years ago? Now, there have been proposals floated that they're going to allow for inflation adjustments on capital gains calculations. And if that were to come to pass, then that would be fantastic. But so far, it's just words. Right? Nothing has passed. We've got a new administration coming in a couple of weeks, and there's all kinds of promises when it comes to tax legislation. So we'll see what happens. That would be something I would be super excited to see because a lot of people rail against capital gains rates and they say it's unfair. You don't really, you're taking a very surface look. You're not looking at what's actually happening underneath. So I think inflation adjusting basis would be phenomenal for capital gains. But again, we'll see.
And so we have another real estate tax strategy question.
Yep.